Attention, let me paint you a picture, grasshopper. You walk into a bank. You're excited. Maybe it's your first home. Maybe you're refinancing. You're sitting across from a nice person in a nice suit who is smiling at you and offering you coffee and acting like they are your best friend in the entire world. And while you're sitting there sipping that coffee feeling all warm and fuzzy, they are picking your pockets. The mortgage industry is one of the most sophisticated ambush operations ever constructed. And most people walk straight into it without a helmet, without a map, and without a single clue of what they're walking into. Not you. Not today. Fall in. Because by the time this video is over, you are going to know exactly how the ambush works, and exactly how to survive it. First things first. Let's understand the battlefield. When you take out a mortgage, you are not just borrowing money. You are entering a decades-long financial relationship with an institution whose entire business model depends on you not fully understanding what you signed. Read that again. Their profit is your confusion. Their revenue is your ignorance. And they have spent billions of dollars making the process just complicated enough that most people give up trying to understand it and just sign where they're told. Now let me show you exactly how they do it. Ambush number 1. The interest rate illusion. The bank advertises a beautiful rate, let's say 6.5%. Sounds reasonable, right? You did your research, you saw that rate on their website, you came in prepared, but here's what they don't put on the website. That rate is just the beginning of what you actually pay. The real number you need to be looking at is called the APR, the annual percentage rate. The APR includes the interest rate plus all the fees and costs baked into the loan. And those fees, they can add tens of thousands of dollars to what you actually pay over the life of the loan. The bank puts the interest rate in big, bold numbers on the brochure. The APR is buried in the fine print on page 11. That's not an accident, grasshopper. That's a coordinated attack. Ambush number 2, the points trap. When you sit down at that closing table, they're going to offer you something called discount points. They'll tell you that you can pay money up front to lower your interest rate. Sounds smart, right? Pay a little now, save a lot later. Sometimes it is smart, but here's what they won't tell you. It only makes sense if you stay in that home long enough to break even on what you paid up front. That break-even point is usually somewhere between 5 and 10 years. The average American moves or refinances every 5 to 7 years. So for a huge portion of the people buying points, they never even make their money back. They paid thousands of dollars up front for a benefit they never lived long enough in that house to collect. Did the banker do the math for you before you handed over that money? Or did they just smile and say it was a great deal? Exactly. Ambush number 3, the escrow squeeze. Your monthly mortgage payment is not just principal and interest. Bundled into that payment is your property tax and your homeowner's insurance held in something called an escrow account managed by your lender. Here's the trap. The bank gets to estimate how much you owe for taxes and insurance, and they almost always overestimate, which means they're holding more of your money than they actually need. That's your money sitting in their account earning interest for them, while you wonder why your monthly payment keeps creeping up every single year. You're funding their operation, soldier, and most people never even question it. Ambush number 4, PMI, the tax you pay for being normal. If you put down less than 20% on your home, and most people do, the bank is going to charge you something called private mortgage insurance, PMI. Now they'll frame this as protection for you. It is not protection for you, it is protection for them. If you default on the loan, PMI pays the bank, not you. You get nothing from it, and it can cost you anywhere from a few hundred to over $1,000 a month, depending on your loan size. The worst part, many people keep paying PMI long after they've built up enough equity in their home to have it removed, because the bank is not going to call you up and say, "Hey, grasshopper, you can drop that PMI now and save yourself some money." They will collect that premium until you wake up and demand they stop. Ambush number 5. The Refinance Revolving Door. Interest rates drop. Your bank or a new lender calls you up and tells you that you can refinance and lower your monthly payment. Sounds like a win, right? Here's what they don't lead with. When you refinance, you restart your amortization schedule. That means you go back to the beginning of a new loan term, where the vast majority of every payment is going toward interest, and almost nothing is going toward your actual principal. You were 10 years into a 30-year mortgage. You had started to make real progress on the principal. Then you refinanced into a fresh 30-year loan. Congratulations. You now have 40 years of mortgage payments on a house you've owned for 10 years, and they did it while making you feel like you were winning. Ambush number 6. Prepayment penalties. Some mortgages, not all, but enough to matter, have something buried in the fine print called a prepayment penalty. This means if you try to pay off your mortgage early or make extra principal payments above a certain amount, the bank can charge you a fee for doing so. You read that right. They will penalize you for trying to get out of debt faster. Because an early payoff means less interest collected. Less interest means less profit. And the bank did not get into this business to leave money on the table. Always ask about prepayment penalties before you sign anything. Counter move 1. Shop like your financial life depends on it, because it does. Most people get 1 or 2 mortgage quotes and pick the best one. That's the equivalent of doing 1 push-up and calling yourself fit, grasshopper. You need a minimum of 3 to 5 quotes from different lenders, not just big banks, credit unions, mortgage brokers, online lenders, community banks. Each one will offer different rates, different fees, different terms. A difference of even half a percentage point on a $300,000 mortgage can save $30,000 over the life of the loan. That's not a rounding error. That's a car. That's a college fund. That's years of investments. Get multiple quotes. Counter move 2. Read the loan estimate, like it's intel. When you apply for a mortgage, the lender is required by law to give you something called a loan estimate within 3 business days. This document is your intelligence briefing. It tells you everything. The interest rate, the APR, the monthly payment, the closing costs broken down line by line, any prepayment penalties, whether the rate can change. Most people glance at the monthly payment number and file it away. That is a mistake. Read every single line. Compare loan estimates from different lenders side by side. Look for fees that seem inflated. Look for charges you don't recognize. Question everything. If a lender gets irritated that you're asking questions, that tells you everything you need to know about that lender. Counter move 3. Negotiate the closing costs. Here is something the bank absolutely does not want you to know. Closing costs are negotiable. Origination fees, application fees, underwriting fees, processing fees. Many of these are set by the lender, and many of them can be reduced or eliminated entirely if you push back. You can also ask the seller to cover some or all of the closing costs as part of your purchase negotiation. In a buyer's market, this is extremely common and can save you thousands of dollars out of pocket at closing. The banks count on you being too intimidated or too relieved to get the loan to question the fees. Don't give them that advantage. Counter move 4. Make extra principal payments. This is the single most powerful thing most homeowners never do. If you make even 1 extra mortgage payment per year, just 1, directed entirely toward your principal, you can cut years off a 30-year mortgage and save tens of thousands in interest. Some people do this by splitting their monthly payment in half and paying bi-weekly instead of monthly. That results in 26 half payments per year, which equals 13 full payments instead of 12. 1 extra payment per year, automatically. The bank does not volunteer this information. They want that interest, all 30 years of it. Monitor and remove PMI the second you qualify. If you're paying PMI, mark the date when your equity hits 20% of the home's original value. At that point, you have the legal right under the Homeowners Protection Act to request PMI cancellation in writing. The bank will not remove it automatically until you reach 22% equity based on the original purchase price. And even then, the process is not instant. Track your equity. Make the request in writing the moment you qualify. Do not leave that money on the table 1 day longer than you have to. Most people treat their mortgage like the weather, something that just happens to them that they have no control over. They sign the papers, make the payments, and spend 30 years hoping everything works out. That is not a strategy. That is surrender. Your mortgage is not just a monthly bill. It is the single largest financial instrument most people will ever touch. And how you manage it, how aggressively you understand it, negotiate it, and attack it, will have more impact on your long-term wealth than almost any other financial decision you make. The banks have entire departments of people whose full-time job is to maximize what you pay them. Lawyers, actuaries, product designers, all working to structure these products in ways that benefit the institution. You have you, and now you have this briefing. The banks built this ambush over decades. They've run it on millions of people who never knew what hit them. You know what hits different, though? A soldier who studied the terrain before they stepped onto the battlefield. Let me give you your orders before you fall out. Get multiple quotes, minimum 3, ideally 5. Read your loan estimate line by line and compare every fee. Negotiate closing costs like your financial future depends on it, because it does. Make extra principal payments every single year. And if you're paying PMI, track your equity and remove it the second you legally can. This is not complicated, but it requires discipline. It requires you to ask uncomfortable questions. It requires you to stop being grateful just for getting approved and start demanding that the terms actually work in your favor. The bank is not your friend Grasshopper. They're a business. Treat this transaction accordingly. Now you've been briefed. You know the ambush. You know the counter moves. The only question left is whether you're going to use this information or let it collect dust like that $997 passive income course. Don't forget to like and subscribe for more of Sarge's money secrets. Fallout.